Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, and we're now up to number 93, all about buying an investment property, and this is part 2, trying to reduce those risks of taking on a pretty sizable investment. There's our disclaimer: facts and figures, information only, not advice in today's little video. Now, as we say, people may be a little bit reluctant to turn around and spend a hell of a lot of money buying an investment property because of the risks. Some people jump in without even understanding the risks. But basically what it boils down to, let's have a look at some of the ways we might be able to just reduce some of these risks so that they're helping us to build our good investment here over time. Number one thing with anything we do with things like buying a property is literally come down to the time frame. This has got to be a longer term investment. It can't be the fact that you're going to buy it 1 year and turn around and sell it next. Now, having said that, of course, if you've bought an old run-down house and you've got the ability to fix it all up and you've been able to improve it dramatically, then turn around and sell it, that was the whole intention, then fine, because generally speaking, in that sort of scenario, you could probably cover all your costs and so forth. But generally speaking, with the property, we're looking for capital growth to make our investment worthwhile. And because of the costs of getting in and the cost of getting out of a property, we need to ensure we're covering those costs. The cost can be quite significant, especially when you're talking things like stamp duty. Could be $50,000, $60,000, $70,000 in stamp duty. That's a cost that we've got to get over. And of course, remembering we've also got to be ensuring that any gain we do make, we are going to pay capital gains tax on it as well. So generally speaking, a longer term investment, and generally speaking, most people try and think of this as around about a 10-year minimum investment there. Then we look at the borrowing costs. If we're going to borrow some money, and generally speaking, we're buying a large amount of money, then the banks have been insisting that you can prove that you can pay this debt back at least 2% higher than what the going rate is at the time. Now, of course, that's been proven to be a bit inadequate over the last few years with the increases that have occurred. So, but basically what it boils down to is if the bank at the moment is offering you a loan for an investment loan, let's say 6%, then you're going to have to prove that you can pay it back at 8%. Now, remembering also that when they look at the income that you're going to be bringing in from a rental property, they won't assume that your rental property is indeed rented out for a full year. They'll basically say, yep, 4 to 6 weeks of this, it could be untenanted, in which case they will look at the income as being reduced because of that situation there. So basically what we're talking about here is building in a buffer, making sure that if interest rates do continue to go up, you can indeed continue to do it and the investment still makes sense. So do all your numbers as if your interest rate is quite significantly higher there. You may want to fix some of your loan, meaning that we lock it in and we are basically saying that, okay, yes, I'm locking this in for 3-4 years at whatever interest rate you can get as a fixed on a investment loan. And of course, that will just give us some certainty, especially in those earlier days when that's when a predominant lot of the costs are involved in those first few years. So if we can keep our interest at a level we know we can afford. Now, of course, depending on which way interest rates are going, then we may find that the fixed rate is considerably higher if banks think interest rates are going to continue to go up, or it may not be much higher at all if the banks believe that interest rates are indeed going to go down. So anyway, just a consideration there to lock it in just for a bit of certainty. Now, most accountants and people with investment properties will suggest to you that when you take on a loan from an investment property, you literally just do it as what's called interest only, meaning that if you need $500,000, then you borrow your $500,000, but you don't attempt to pay the $500,000 down. You just literally just pay the interest on it. So next year you still owe 500 and so it goes on. The benefit, of course, is the fact that your repayments are less because you're only paying the interest on it. You're not trying to pay the principal down. The interest is the bit that is tax deductible. And of course, the idea is that as your capital growth of your property goes up, eventually the capital growth will go up. We'll take it, we can pay the debt back, and we clear the difference. But I must admit, what I sort of would prefer, of course, it all comes down, can we afford to do this, and does it make sense with whatever the interest rates are and what you're trying to achieve, is perhaps consider paying down some of the principal. The idea being that if you do indeed pay down some of the principal, you are indeed increasing your security, you're increasing the equity. And so if house prices did drop, then because you've paid off some of the principal, you're not going to be in the situation where your debt could indeed be higher than your the value of the house. So you're just building up a little bit of extra security by doing it. And over time, it may be the wonderful situation that you've paid this thing off. Now, of course, your accountant will say, oh, well, you're missing out on tax deductions. Well, perhaps we then turn around and buy another one. But I say, I don't mind paying tax. It just means I'm making more money there. Obviously, if we're trying to reduce our risk, the more income we've got coming in, the better off our scenario is going to be. And of course, this should be a target anyway, without just trying to reduce risk. But obviously, the more money we can have coming in from a rental property that's paying us a good rent, then obviously that's going to help the scenario there. And same sort of deal, if we can reduce our loan to value ratio, meaning that, yes, I say a lot of people with interest, a lot of people with investment properties will use perhaps the equity of their home to buy it, so there's no deposit, they borrow the lot, and so their loan is effectively the same as the value. There's not a lot of wiggle room there if things go wrong. If we do use some cash to create the deposit, then only borrowing 80% or whatever the case may be, then obviously if house prices change, we've still got ourselves a bit of room there to move. So just again, it's all about this giving ourselves a bit of security if things just don't go quite the way we expect. And of course, Murphy's Law certainly has a way of coming into things when we all of a sudden put large amounts of money on the table. Now, of course, if you the first investment property's done well, you've generated some lot more equity, your tax deductions are going down, and your accountant or whatever, you feel comfortable in buying another one, then to reduce the risk, don't buy another apartment in the same block. Unless there's an absolutely really, really strong good reason why you would, in the fact that you know that this particular area is really going to go ahead because of something that's happening. But normally not a big fan of buying in the same complex, especially in the same complex, but I don't even like buying in the same suburb, and ideally not even in the same city. If we can buy in diverse areas, then of course, we know the difference in some areas, they change. Now you're not necessarily going to get it right, but it does mean that we might be buying an area that's going well at the moment, but that area slows down and the other area is the one that takes off. And so therefore we're basically getting a bit of diversification in our property portfolio by keeping them separate. I think the worst scenario I've ever seen is where a couple bought 4 properties in a mining town. Yes, the yields are very good, but of course, when the mining town decided to build men's quarters and accommodation wasn't required in the town, those people were left with not a lot of value. Common sense says don't overcommit, so we're not going to stretch ourselves to the point where, as I say, if things just don't go quite according to plan, we're left in a situation where we've got to make some tough decisions, either to sell at a loss or sell at an inappropriate time, or basically have to borrow more money or whatever. Simply just keeping it to a level where we've got ourselves a bit of buffer. Things don't go quite right, we can effectively accommodate. And of course, in that situation also, look at your salary. what portion of your salary you're using for this thing. If this thing is negatively geared, we're going to talk about this in upcoming sessions, then effectively it boils down to is you're eating into your own income. What effect is that having on your own lifestyle? And what happens if, of course, should you lose your job? Any investment property, don't get too emotionally attached to it. It is just an investment. So it's a case of just because you love it and where it is and think I could live there, unless you've got intentions to actually live there, then if the investment as an investment just doesn't make sense, meaning that it's difficult to rent, it's not going up in value, it's becoming quite expensive to maintain, all these sort of things costing you money, you're increasing your risk as time goes on. If those things don't improve, then how about thinking about, getting rid of it and replacing it if you so desire. Ideally, surround yourself with some professionals. A good accountant in the first year or two, certainly a good idea to get yourself set up. Good mortgage broker to understand what you can do and what you can effectively achieve with the various different styles of loans. Having those sort of people, and it could be a case that you even get a property purchaser, one of these people that goes out and finds an appropriate place for you, does the bargaining for you, and so it goes on. Those sort of things, yes, they cost you money, but indeed, if you've got some professionals and they are true professionals looking after you, yes, you've got to pay them. You could find that the money you've spent is indeed money well spent. Happy to have a chat about any of these issues, but we will continue on in future sessions.